started. Come on. Come on. All right, everybody. Let me make sure the Discord audio is on. Yeah, we're good there. All right, everybody. Welcome to Shock Stock Saturday class for beginners. It's a free class that I do on the weekends. Try to run at least 2, 3 of these a month for you all to make sure you are progressing through your knowledge into learning the basics of the stock market. All right, we went over basics of the stocks, of understanding stocks and how to invest in stocks and what platforms to use, etc., etc. We went and did the review, put a quiz out there for everybody that was in the classes and participating and in the Discord community. They are learning and we are growing together as a team. I love it when the people who are just catching on to investing start to grasp the basic concepts and start to understand them, because these are the concepts that are going to take you far in the market. All right. But now I want to do introduction to option trading for all my beginners out there who are maybe more advanced in stocks but are just starting to get into option trading. This is the class for you. So all my option traders out there and investors, or my aspiring option traders, lock in and pay attention as I teach you what an option contract is. Some people are getting into options and they don't really even understand what they're buying. They're just looking at, other people trade live and they're just kind of shadowing their moves and buying contracts and selling contracts, but they're not even really sure what an option contract is and what it represents, okay? So you think of an option contract, it's like a reservation at a restaurant, right? It gives you the right to go at that time that you reserved for, but you're not obligated to go. You can always cancel that reservation at any given time and say, you know what, it's about 3 o'clock. I've decided that I don't want to go to this 5 o'clock dinner reservation anymore that I booked last week. Okay, so you do the same kind of thing with option contracts. It's an reservation but not obligation, and you get to pay a specific price on that reservation for doing it early. So if this restaurant tends to, let's say this reservation, you had to pay a deposit for $20, but that locks in the price at $200 for you. And you think that these tickets that you're reserving are going to go up to $300 in value for this restaurant that you're reserving seats for, right? So you're reserving these seats. Maybe there's a function or something going on, and you feel like, oh, these tickets are going to go up in value, so I'll be able to resell them and make $100 on these tickets instead of actually having to go to the dinner. And the example I give here is sneakers. So we could use sneakers or take a comparison. Sneakers, you buy sneakers that are worth $200. This is something that's maybe more relatable. And you think they're going to be worth $300. A lot of people do reselling of sneakers. And because you know some kind of celebrity is going to promote them the following month, or you just know that a celebrity promotes them already and you're able to get them at this value, but you know the resale value is going to be higher within 30 or 60 days from now. So you pay $20 now to reserve the right to buy them for $200, right? So you paid a $20 reservation fee, but that allowed you to get them for $200 at any time in the next 30 days when they're first released. That's a beautiful opportunity. Now, if you see the price of the sneaker is not going up to that $300 in the next 30 days, you're going to have to make a decision. Do I want to sell it at whatever the value is at now? Maybe it only went up to $220. Maybe it went up to $240. Maybe even went down to $190. You got to decide, do I want to hold it for the whole 30 days and see how much it's worth by the end of that? Because at the end of that 30 days, you're obligated to spend that $200, because that's what you paid the reservation for. So if you don't get it right and the sneakers are worth less, you're going to pay that $200 and you're actually going to take a loss. Let's say if they're worth $190. But if they are worth $300 like you anticipated, you're going to make $100 on those sneakers. And sometimes they could get to that $300 value before the 30-day period. So you could go get the sneakers then and then sell them right there on the spot and get your $300. That's how an option contract works when you're doing a call or a put. It's like, oh, I got this contract now. I paid $20 for it, right? And now I see, okay, wow, I'm going to see the value of this option contract go up from $20 a contract, and I see it go up to $30 a contract. It's the time to sell now. You made your profit because you don't want to sit there and say you want to see it go to 350, even though it potentially can go up because it went to 300 before your 30 days was up. It could potentially go up even more, just like the sneaker value could go up even more. But that's up to you to decide if you want to hold because it potentially could come back down in value as well. So that is the basic operation and function of an option contract. The two types of option contracts we have call options and you have put options. The call option is to right to buy a stock at a set price. So this is when you're expecting the stock to go up because you're going to want to buy it at a set price. And you're paying a deposit, like we said earlier. It's like paying a deposit on those shoes or a car, expecting the resale value to rise. And in the put, you have the right to sell at a set price. So if you think that sneaker value is going to drop, right, and you want to make sure you lock in the value at $200 and it goes down to $150, you made $50 per sneaker that you bought. You understand? Because they're going to give it to you for $150, but you have it locked in at the $200 price. So you're betting that a price of something will go down. So it's almost like buying insurance, like I have stated in here. It's buying insurance on a product or an option contract, which is what we're talking about, options. So puts are option insurance or hedges against long positions as well. You may have a long stock investment position that has been going up, 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 and you feel like it's near an all-time high and it's starting to get shaky at the top. So you want to say, okay, let me go ahead and I don't want to sell my stock. So instead of selling my stock, you'll buy a put option. And now if the stock starts to come down, your put option will go up in value and it'll stop you from it'll offset the loss that you're taking in your long-term position. It may even make you more money than you lost in your long-term position if you sell it at the right time before your position starts to come back up in value. Some key terms for option trading. You have strike price. The strike price is the locked-in price you can buy or sell at. So think about the sneakers, the $200 the price that you locked in the sneakers at. That is your strike price. Expiration date. The expiration date is the deadline you have to act on. So we had 30 days to act on those sneakers. So 30 days before your reservation rights end. So you have to act on that $200 sneaker price within that time frame or sell it for more within that time frame. The premium, the upfront cost of the deal, the $20 deposit fee was your upfront cost. Okay, and that's your premium. That's what you're going to pay up front to be able to have the right to sell later at that price or higher. The intrinsic value. Intrinsic value is the real profit inside your deal. So if the shoe is worth $300 and you locked it in at $200, your intrinsic value is $100. So you make $100 difference because you still got to pay $200 for the sneakers, but you're selling them at $300, so you just make that $100 difference. And then you had the time value. This is very important when we're talking about options. I'm going to start explaining this later when it comes to the Greeks. But time value is the value and potential, the time, and the hype, and the volatility. So when those sneakers first come out, it may be very hyped up, right? So the time value is there. You have a lot of, and it's still within the early part of your 30 days. So this time value is important because this is going to determine how fast the value of the sneaker goes up or down. So the sneaker just comes out. A lot of the times that first week, the resale value may be hot because the sneaker just came out. Everybody that got it, you can't get it at the stores anywhere. You can only buy it from people who are reselling it. So now you have a real big chance of making a good amount of profit because a lot of people want this hot sneaker. And they're willing to pay maybe even more than $300. Maybe they're willing to pay $400 in the first week. But now the second week comes, more people have the sneaker. Stores are starting to restock a little bit. People are able to get it now, or people are looking at being able to get it now, not for $400. Some people are selling it for $320 because they bought it for $200 and they're just good making $320 on it. And now that value starts to come down as time elapses. And now, because people also have to sell theirs within 30 days, just like you do. So as closer we get to that 30-day period ending, the more likely that value will start to go down drastically because people are starting to sell. People are trying to take their money out quicker before that 30-day period ends. So you want to be someone who is able to hit their target profit early and be able to take your profit early and not be in it all the way close to your expiration date or your last day or your 30 days, okay? That's time value. That's going to deal with different Greeks, okay? We got gamma and all that kind of stuff. I'm going to break those down to you guys later. But those are very important. We're going to do that in part 2. Let's do a real stock example. A lot of people wear Nikes, right? I'm pretty sure you got some Nikes on right now if you got sneakers on. But a lot of people wear Nikes. Let's say you get a strike price at $100. So remember what we said the strike price is, okay? The strike price is the price that you're locking in that you have the right to buy or sell this stock at, whether you're doing a call or put. Well, we're doing a call here. So this is the right, you have the right to buy Nike at $100 because you're getting $100 strike price. Expiration is in 30 days. You only have that right for 30 days. Okay, this is not eternal. You don't have the right to buy Nike at $100 for the rest of your life. Only for 30 days. Okay, and then you have the premium. It costs you $3 to do this. Now, $3 in stock in option talk is $3. You got to multiply everything by 100 because you're getting control over 100 shares when you're doing option contracts, and that's the value and advantage and power behind options. It gives you a leverage position, so you don't have to go out there and buy 100 shares of Nike at $100. You could buy instead of 300 shares of Nike. You could go ahead and buy $3 worth. You could buy $300 worth of Nike instead of paying the full amount that you're going to have to pay for that amount of shares. So if you had to buy 100 shares of Nike at $100, you're thinking about that. That's like $10,000. So $10,000 worth of Nike, you're getting control of that for $300, and that's the power. But you only have that control for 30 days. Okay, people who own the stock, if you bought the stock, you can hold Nike for as long as you want, and that's the difference, and that's why it costs you so much more. But that premium of $3, okay, so we got 30 days to make this sale happen. We want to make sure that it gets to, we're gonna say it's gonna be at least worth $100, but we want it to be worth more than that. So we wanted to say it goes up to $110 in value. So now you paid $3 for your premium, and the stock goes up to $110. Or your premium goes to $10. So now you sell Nike at $110 and you had the right to buy, and you bought it for the right to sell it at $100. So that $3 you paid in premium, you're gonna add that onto the 100. So you're gonna say $103 you paid, and then you're gonna add. Then you're gonna say, okay, 110 minus 103, you made $7. So that you end up with $7 in your pocket after that sale. Okay, and that's gonna be in option terms. 7 times 100 is $700. So you paid $300 for this, and because Nike went up to $110, you ended up making $700 on that. But it had to happen within that 30-day period, or guess what? If Nike stays underneath $100 and you have that $300 premium in, or that $300 premium in, and that 30-day ends, and Nike does not get over $100, your contract is going to expire worthless. Okay, you're going to lose that $300. So the power is you control $10,000 worth of Nike for $300. The risk is if you're wrong, you could lose that entire $300 if it doesn't happen within the time frame you expect. Okay, so that's the big risk with option trading, and that can happen much quicker than you think in most scenarios, depending on what's going on in the news, what economic reports are coming out. All these things play a factor into how your option contract may be affected based on how it causes your stock price to move. All right, we're going to do a put option example. We're going to say Tesla. You're going to believe Tesla is going to have a put, meaning that you believe the stock is going to drop, and you're going to believe it's going to drop in a couple weeks. So you're going to say this is going to happen within 2 weeks. This is not even 30 days this time. This is 2 weeks, you're saying. So you're going to say you're going to keep the right to buy Tesla at $200 for the next 2 weeks, and it costs you $5 or $500 to do that, okay? So Tesla goes from $200 down to $180. Guess what? You paid $5, so your profit is $20 minus the $5 times 100. So the $20 minus $5 is going to be $15, and that $15 times 100 is $1,500. So you paid $500, but because Tesla went down to $180 in less than 2 weeks, within that 2-week time period, buy this contract literally at 10 o'clock in the morning, and Tesla could drop from $200 to $180 by 10:30, and you make $1,500. That's the power of option trading. This is why people gravitate towards option trading, but I think you have to understand the leverage you're messing with and the risk you're also dealing with, and understand where you need to be looking for your profit taking at on price levels on the chart, and not be getting too risky with this, because this is a quick way to drain your account if you keep putting all your money in options. This should only be, I always tell people in my community, keep it within like no more than 30% of your portfolio. 20%, I really say, of your overall portfolio, you should probably dedicate towards option trading to help build up, you know, some of your long-term positions even faster than just from your job and whatever income you have coming in, building up your investments. You could use this option trading to create income to help develop your long-term positions and build up your equity even faster. All right, and you could do that even when the stocks are going down. So as you see with the puts, strike price $200. So that means you got the right to buy Tesla. You got Tesla at $200 in value, and when it drops down to 180, you're gonna make $20 in premium on each one of those contracts because it dropped down by $20. But you only pay $5 for that. So you got that insurance on it. So now your Tesla contracts are still worth $200. Okay, you paid $5 in insurance. You paid $500 in insurance for that, and now because you pay $500 insurance, you can still sell your contracts. You can still sell your Tesla shares at $200 a contract. And remember, this is times 100. So you have 100 Tesla shares that you're doing that with. And you're selling them at $200 a contract when the current price is 180. So you make that $1,500. So you make money on the stock price going up or down. But like I said, if Tesla stays above 200 and that 2-week time period ends and Tesla does not dip down for you, you're going to lose that entire $200. And it may go down in profit very rapidly. You'll see it go down, the premium value go down day after day as it gets hit with time decay, or theta as we call it. It's one of the Greeks that you're going to have to really, really get familiar with, because theta is one of the most, theta is your biggest enemy when you are in an option contract, especially a short one. Okay? 3 major forces that affect option prices. You have the stock price movement, which is going to be shown in the Greek called the delta. So when you go and look at your option contracts, you're going to see, or when you go to look to buy an option, you're going to scroll over, you're going to see the delta, you're going to see the Greeks up there. You're going to see the theta, the delta, the IV, the rho, the gamma. But I will break all those down in future classes. Right now, just focus on the delta, which is going to determine how much your contract moves based on every dollar the stock moves up or down. And the closer the stock is to the strike price that you purchase, the higher the value of your contract is likely to be. So the more in the money your contract is, that's what you're going to hear a term, in the money. So if you buy a strike price at $100 and the stock is already at $105, you're going to be considered in the money. Okay, so you already got secured. You're already going to see that you're above that strike price. That's considered you're getting ready to be you're in the money on your contract, because you paid $100, it's at $105, you're already considered in the money. Okay, time to expiration. How long before the contract expires? Is it 2 weeks? Is it 30 days? Is it a year? Is it 2 years? Is it 3 years? The more time, the more opportunity you have for it to hit your price, your strike price, and then get you past your strike price and even in the money. So in the money is considered let's say you paid $3 for those Tesla contracts that we were talking about. Okay, once you get past $3 in premium value on your contract, once that Tesla contract goes down from 200 past 197, now it's past $3 in premium value. Once you get past that 197, now you're going to be considered in the money, because now everything you make after that is going to be profit on top of the $3 you spent on the contract. So that's how in the money, and usually at that point your delta is increasing, so your contract is going up in value even faster once you're in the money. That means that you predicted the price movement correctly, and the more it moves in that direction, the faster you're going to gain value on that contract. And then you have the volatility. So that's going to tell you, like I'm just talking about, how wild the price swings are. How wild the price swings are in the stock itself, how volatile is the stock you're investing in. So they have ETFs like S&P 500, the QQQ, what you got? But you also have risky ETFs like the IWM, which is the Russell 2000. Every one of these has a different level of volatility. So when you're trading a stock, you have to look at that stock's implied volatility to see how volatile is this stock. meaning how much does this price typically go up and down within a day. And if it's a really high implied volatility on a stock, usually the option contracts are going to be more expensive because you have a much higher chance of the contract going above your strike price and then into the money even faster than any other stock, because this stock moves up and down in price very quickly. So those contracts tend to be expensive, but you can lose your money on those the fastest as well. So talking about losing your money fast, risk and reward. You can only lose what you pay on the stock on the option contract. So if you put $500 in an option contract and you bet the stock was going to go up and it starts tanking, no matter how far down the stock goes, the stock could go to zero. The most you could lose is your $500 that you put in. There's not going to be any more than that. All right. The only time you can lose more than that is in other scenarios, which we'll talk about in the future. But those are going to be scenarios you'll get into with knowing that that's the potential. With basic option trading, you can't lose more than the premium you paid. You control large positions with small amounts of money. So $300 we talked about gave you control over $10,000 worth of a company before. So of Nike we were talking about. So that's one of the rewards that you get with option trading. If you're wrong, the biggest risk is that your contract can expire worthless. So timing is everything. That's why I have theta high right here, because theta is going to let you know when you need to be looking to sell your contract. When this theta number gets too high and you start seeing time start eating at your contract more and more and more, then you know it's about time to get out your contract before it becomes worthless. Options, high reward with defined risks. You must learn how to manage the time, risk, and volatility. Those are the three major things: time, the risk, and volatility. The risk is really dependent on your portfolio. Like I said, keep it in that 20% range. That'll help keep your risk mitigated and under control. Also, the time helps your risk. If you buy more time, it helps lower your risk even more. And then volatility. What are you investing in? Are you investing in a bunch of penny stocks that are jumping up and down in price every day all over the place? Are you investing in ETFs like the S&P 500? Are you invested in tech companies that are volatile in price movement like Tesla or Google, Nvidia? Or you got, those are some of the more stable ones actually: Google, Nvidia, Apple, Microsoft. Or are you invested in companies like Palantir and Tesla? Tesla's more volatile. Coinbase. These are very volatile companies out there that people make a lot of money on and also lose a lot of money on. So the assignment I have for you all, I want you to go to Robinhood, eTrader, Webull, open up your options tab. Anybody in the Discord community, you have any questions, you come to me. I will help you beginners. And if you have questions in the YouTube, type in the comment section. I'll respond for you. Try to help guide you on how to find the options tab if you can't locate it. And then I want you to write down one call option and one put option. Find a company that you like. Find a company that you're interested in and whose price you feel like you can predict the movement on. And I want you to find the price moving in that, or the contract for that direction. If you think it's going to go down, I want you to find the put. If you think it's going to go up, I want you to find the call. All right? I want you to find the strike price. I want you to find the expiration that you're going to get. And I want you to understand what the premium is. And then I want you to ask yourself, what direction am I betting on? What's my total cost? And how much would I be able to lose if I bought this contract? And what price does the stock need to reach for me to be in profit on this contract? Now, what a lot of people don't understand with option contracts is when you buy options, a lot of the times people think that it has to hit their strike price for them to be making any money. It's not true. When it hits your strike price, a lot of the times, if you're in an option contract and you bought it before it got to your strike price, so you got a $100 strike on Nike, and say Nike was trading at $97 when you bought that. That $3 you spend on Nike on that contract, or $2 you spend on that contract, soon as Nike moves from 97, as soon as it goes to even 97.50, as long as it's within a certain time, because that's where the time factor comes in. It's like a scale. If you buy it and you have 30 days on it and it goes from 97 to 97.50, 98 within the first day you bought the contract, you're going to see profit on your contract immediately. You're going to be able to sell it for more than what you bought it for that very day. And that's a decision that's up to you to make based on how much percentage profit you're looking for, and if you want to keep holding it as it gets closer and closer to your expiration. So you don't need it to hit your strike price to make money. That's the misconception a lot of people have when they first get into options. They get confused. They think that they have to hit that number or get above their strike price for them to make money. That's not true. But that is the price that you are looking for, and that's where the price of the contract is more likely to start having profit for you. Definitely when it hits your strike price. As long as it's at that price before expiration, you're likely to be in profit. So anytime within that 30-day range, if it's above your strike price within that time range and you bought it while it's below, you're going to be in profit. But if it stays below that strike price as time keeps going on, you could be in profit the first day because it went up $1 to $98. But as time goes on, if it stays at $98 for the second week and third week and never gets over 100, you're going to end up down. You're going to end up in the negative on that contract. Okay? So, thank you all for joining me. That was your introduction to options. We're going to continue options and we're going to advance through this course just like we did with the stocks. Then we're going to do a review for the beginners and break it down. And then we'll advance to the advanced scale. Okay? I'm taking you one step at a time. I know people have lives. People are taking time out to try to study and learn this. So I'm not going to try to move too fast, but I also am here for you to reach out to. Okay, reach out to me on TikTok, or you can reach out to me on YouTube, or you can join the Discord community. Scan this QR code right here. It'll give you links to all of these, and you'll be able to join and reach out to me directly with your questions. All right. Thank you all for joining, and I will see you next week.